I want to talk a little bit about the business and the strategy of value-add multifamily real estate, especially the way Trion does it. So what we do is we target assets that are in high growth areas, which is why we're in the East Bay, which is why we're in Portland, Southern California, markets that have high population growth, high job growth, high quality of life. And in those markets, we target assets that have been under legacy ownership. And what I mean by that is assets that have been with the same ownership for 10, 15, 20 plus years, where the owners have a very low cost basis, a very low debt basis, which disincentivizes them to put more money into the assets and to charge higher rents and to keep the assets at top performance. And what that creates is a mismanaged asset. So we target these assets that are tired and need some TLC and they're grossly mismanaged, and the rents are usually significantly below market. So what we'll do is we'll buy the asset, we will put in an extraordinary amount of capital improvements. We put together a capital improvement program where we are putting money into the common areas and doing a full common area reset. We'll take old rec rooms, which are just 4 white walls and a piece of carpet. We'll gut it. We'll put in a fitness center. We'll put in a co-working space. We'll put in a updated rec room, but we're finding new ways to reimagine some of the common areas of the assets. We're putting in new pool furniture. We're painting the exterior. We're putting slurries on the lot. So it's a full common area reset. And then the units, as they turn, will improve the units. We're typically spending, where a lot of our competitors are spending $5,000 to $10,000 a unit. We're spending $15,000 to $25,000 a unit, because what our model is we try to deliver the best Class B plus product in the marketplace, so that it has a Class A kind of feel, but our rents are still 20% below the Class A rents. So we're not competing price-wise with brand new product. We're about 20% below that. And the feeling might not be quite exactly brand new, but it's pretty close. And a lot of people are happy to save $500, $600 a month so they can get something that's close to brand new as opposed to being brand new. Class B properties perform great in downturns. We avoid Class C because oftentimes in a downturn, those are the first jobs to be eliminated. So we don't want to have too much exposure to that. Class A, what you see is those very large rents tend not to hold, and you see steep declines in those rents. Whereas Class B, you don't see quite as many ups and downs, and it's a much more stable product. One of the key components to our value add strategy is making the money on the buy. And to make the money on the buy, you have to buy properties off market. The vast majority of our acquisitions come off market. There are ways to do that. First of all, we're very careful with how we buy, very disciplined. If we're in a marketed situation, we try not to let our get emotions ahead of us and be the high bidder. So we set a bar and that's where we bid. With regards to off market, what we do is we get into a process on marketed properties, and we'll throw in our bids, and the brokers see how we underwrite. They see what kind of terms we use, that we're pretty aggressive on price, even if we don't win the deal. And then even if we don't win the deal, they'll start to bring us off-market opportunities, and that's where we can really shine. We'll write very aggressively on terms. We'll oftentimes put some non-refundable money up day one, and that helps improve our situation, and it's incentive for brokers to bring us deals off-market because they know we'll perform.